You've probably seen those crazy posts online. I turned $100 into $10,000 overnight, or I got liquidated in 5 minutes. Yeah, that's leverage trading in a nutshell. And here's the wild part. During the recent crypto crash, billions of dollars vanished in just hours, mostly because of traders using too much leverage. So let's break it all down. What leverage really means, how it works, why people love it, and how it can completely wreck your portfolio if you're not careful. Stick around till the end, because I'll also share some real examples of what went wrong for many traders during the recent crash, and what you can learn from their mistakes. Alright, so first things first, what even is leverage? Leverage is basically borrowing money to make a bigger trade than you could with your own cash. It's like trading with a turbo button. If you have $100 and use 10x leverage, you're now trading with $1,000. That means every 1% move in price is multiplied by 10. Sounds awesome, right? Well, until it moves the wrong way. Because just as leverage amplifies your gains, it also amplifies your losses. If the price drops by 10% while you're using 10x leverage, boom, you're wiped out, gone, liquidated. Say goodbye to that $100. So in simple terms, leverage makes small price movements feel huge, for better or for worse. Now, let's go one layer deeper. When you open a leveraged trade, you're using something called margin, your own money that acts as collateral. The exchange lends you the rest. If the market moves against you too much and your losses approach your margin, the platform liquidates your position, meaning it automatically closes your trade to make sure you can't lose more than what you put in. That's called a liquidation. And trust me, when that happens, it's not fun. It's like watching your wallet disappear in slow motion. To put it visually, $100 with 10x leverage gives you control over $1,000 worth of crypto. If your position drops 10%, that $100 is gone. If it goes up 10%, congrats. You just doubled your money. It's like playing with fire, warm and cozy when it works, but your eyebrows are gone when it doesn't. Now, there are two main ways people use leverage, going long and going short. When you go long, you're betting the price will go up. When you go short, you're betting it will go down. So yeah, with leverage, you can even profit from a market crash if you get it right. There are also different markets for leverage trading. Spot margin trading, where you borrow assets directly, and futures trading, where you're trading contracts based on price. Most crypto leverage trading today happens in futures markets on platforms like Binance or Bybit. They let you choose your leverage level, sometimes up to 100x, which is insane by the way. At that point, even a tiny move against you, like 1%, can erase your position instantly. So unless you enjoy the thrill of financial cliff diving, don't start with 100x. Now you might be thinking, if it's that risky, why does anyone use it? Simple, greed and potential. Leverage lets small traders play big. It makes you feel powerful, like you're part of the whales moving the market. And sometimes it works. If you catch the right move with proper risk management, leverage can multiply your profits dramatically. It's like adding hot sauce to your meal. Just a little can make it exciting, but too much, and you're chugging milk, regretting every life choice. So yes, leverage can be useful, but it requires discipline and a solid understanding of what you're doing. Now let's talk about the ugly side, the part most people learn the hard way. The biggest danger with leverage is that it tricks you into overconfidence. You start small, maybe 2x or 5x. You make a profit and it feels great. Then you think, hey, if I made $20 with 5x, imagine 50x. And that's how it starts. So there are a few mistakes beginners often make. We're talking about things like using too much leverage. That's a big one. You also see people not setting a stop loss. They just let things ride. It's really common to see revenge trading as well, where you're trying to win back losses right away. All of this generally boils down to trading emotionally instead of logically. And the worst part? When thousands of people all get liquidated at the same time, it actually makes the crash worse because the exchanges automatically sell off those positions, pushing prices down even faster. So, leverage doesn't just ruin individual traders. It can shake the entire market. Now, let's talk about what happened during the recent crypto crash. Within just a few hours, Bitcoin dropped sharply, and that triggered a chain reaction. Over $19 billion worth of leveraged positions were liquidated across multiple exchanges. Most of those were traders who went long, betting that the price would rise. But when it started falling, the liquidation engines kicked in. And once the dominoes started to fall, it accelerated the crash. Imagine thousands of people all being forced to sell at the same time. That's exactly what happened. Some traders lost everything they had in minutes, not because the market was evil, but because they didn't respect the power of leverage. So next time you see headlines about millions liquidated, just remember, those weren't just numbers. Those were people, many of them beginners, who thought they were playing it smart. Now here's something most people don't talk about. Leverage messes with your mind. When you know that every tiny move can double your money or wipe it out, your emotions go wild. You start staring at charts every second. You panic sell when it dips and FOMO buy when it pumps. Leverage creates stress trading, not smart trading. And that emotional roller coaster is what destroys most beginners, not the market itself. So if you ever catch yourself checking your open position every 10 seconds, heart racing like you drank 5 espressos, yeah, that's your brain telling you it's time to lower that leverage. Now for the practical part. How can you use leverage safely, if at all? So here are some simple but crucial rules that can literally save your account. First off, you need to start low, like 2x or 3x. Why? Because the goal is to learn, not to gamble. Second, always use a stop loss. This means you decide beforehand how much you're willing to lose. And please, never risk more than you can afford to lose. Seriously, don't use rent money. Also, don't trade when you're emotional. If you're angry, excited, just walk away. You must understand liquidation levels. You need to know the exact price where your position gets closed. And finally, before you jump in with real money, use testnets or paper trading first. Most exchanges offer demo accounts. Use them. Remember, the best traders aren't the ones who make the biggest wins. They're the ones who survive long enough to keep trading tomorrow. Now, leverage isn't evil by itself. It's just a tool, like a knife. You can use it to make dinner or, stab your portfolio. Professional traders use leverage carefully, with strict risk controls. They might use 2x or 3x leverage to hedge positions, not to gamble everything. But beginners often see it as a get-rich-quick button. And that's why exchanges love promoting it, because when you get liquidated, they still collect the fees. So the lesson is, treat leverage like nitroglycerin, handle with care, and never while half asleep. Let's tie it back to the big picture. Every major crypto crash, whether in 2021, 2022, or this recent one, had the same pattern: too much leverage. Traders pile in when the market feels unstoppable. Everyone's using 20x, 50x, 100x. Then a sudden dip happens, maybe just 2%, and that's enough to liquidate thousands of over-leveraged positions. The result? A cascade of forced selling, a massive red candle, and chaos on social media. So while leverage makes markets exciting, it also makes them fragile. And understanding that helps you trade smarter and stay calmer when things get volatile.